Welcome to Looking at the Markets with David Modell. Today I will tell you about an options strategy that is actually pretty simple. It only involves two options, and it is called the long combo. And it is a way to sell a put option but also get unlimited upside potential on your options trade. So I hope that if you want to buy 100 shares of a stock, I hope that you're considering selling a put option. That way, if you get assigned, you'll buy the stock at an even lower price than the current share price if you sell an out-of-the-money put option, okay? Why just buy 100 shares of a stock and pay the same price as everybody else when you could buy it at a discount, right? And so let's take Twitter, TWTR, as an example. And this is the Schwab web interface, okay? And Twitter is really close to its 52-week low. When I'm making this video, Twitter stock has been as low as $41 and as high as $80. So if I were to buy it at $40 a share, then maybe it'll double in price. Maybe it'll go back up to 80 and I could double my money. That would be something, right? If I get assigned. If I don't get assigned, then okay. Well, think about it. If you sell a put option at 40 for Twitter, it's selling at 42.66. You sell the 40 put option. Now you're buying it at an even lower price than the current price, and you're getting paid to do it. So right now I would collect around, let's say, $237 per put option contract. If I sold a put, I would collect around $2.37, let's say, per share, or $237 per contract. Pretty good, right? And so I would collect that premium right up front, and maybe Twitter would go below 40, and maybe I would get assigned, or maybe not. Maybe right after I sell the put option, Twitter stock might just shoot up like a rocket. It might go up to 50, 60, 70, 80, 100, whatever. And I would feel kind of left out of the rocket ride, the moonshot. I would get left out, right? Sure, I would collect $237 or so up front. That's great. But I wouldn't get to participate in the moonshot. I wouldn't have that unlimited upside potential. And I mean, I'm okay with that. I don't mind just collecting a smaller amount, and that's fine, and not having unlimited upside. But some people want that unlimited upside potential. And so what you can do is sell the put. You want to sell probably either at the money or out of the money. I sold an out of the money put, meaning the strike price is below the current stock price. Okay, current stock price $42.66. I sold an out of the money put, $40 strike price. I made it 2 months out or so. Okay, so around 60 days or so out in time. But if you want that unlimited upside potential, then what you can do is you can also sell a call option out of the money. You're selling an out of the money call option, same expiration date. And so what is an out of the money call option right now? Well, if Twitter is 42.66, I could have sold a 45 strike. That's out of the money, right? It's higher than the current share price. 46, 47, 8, 9, 55, 60, whatever. Okay, I chose 50. And you want to spend on that call option you're buying, you want to spend less money than you collected when you sold the put option. Okay, so check it out. See, if I sell this 50 strike call option, I would collect around $1.29, let's say, per share, $129 per contract I'd be spending. That's less than what I collected, the $237 per contract for the put option I sold, okay? And so I'm still collecting a credit up front. You see that? Of around $108 or $1.08 per share, right? $108 per contract. So make sure you're still collecting a credit up front. You don't want to pay more for the call option you're buying than you're getting or collecting for the put option you're selling, all right? So as long as you're still collecting a pretty good credit, you know, I'm collecting a little bit over $1 per share, a little bit over $100, not bad, okay? So if I get assigned, I'm still, buying Twitter stock at 40, and really I'm getting paid $1 per share. So net, I'm buying it at 39, really, when all is said and done. That's still a pretty good discount. That's below the 52-week low of Twitter. And you get to participate in unlimited upside if you do this, because you bought a call, you bought a $50 call. And if Twitter, before the expiration date, goes to above 50, if it goes to 51, 52, 55, 60, 80, 100, yeah, Twitter could just keep going, and you're collecting more and more money because your call option is worth more and more and more. Unlimited upside potential right there. And you're still collecting a credit. It's not as big, the credit you're collecting. Okay, granted, it's not $237 anymore. It's just like $1, but still pretty good. Okay, and that's called the long combo. So sell an at or out of the money put option, and you can make it, let's say, a couple of months out, or however long, whatever time frame you like, a month out, a couple weeks out, whatever you like the best. And then buy an out of the money call option, but not more expensive than the put option you sold, and still collect a credit. Let's take a look on Options Strat. This is optionstrat.com. I like to use it sometimes. It's called the long combo. So you go to build and you look for long combo. There it is. Click on that. Type in Twitter or whatever stock you like, and then make the adjustments. Put in the right date, expiration date that you're using, the one that you want, and then move these around until you get the strike prices that you want. Again, okay, selling a 40 put, buying the 50 call. There it is. All right, and you can see what that looks like, and check it out. Max profit infinite. Okay, net credit. There it is. A little bit over $100, right? Yeah, they rounded it up to 109, let's say, if you get the mid price, right? And check it out, unlimited upside. It could just keep going up, up, up. The call option that you bought, if Twitter stock just keeps going up, up, and up, right? And, before expiration, check it out. Even if the stock goes down a little bit, you can still profit, right? Can't go down too much for you to profit. But what's the worst thing that happens? Okay, you get assigned, and maybe you hold on to Twitter shares, Twitter stock, and maybe the stock will go back up eventually. And you're holding stock, so there's no expiration date for the stock. Even if it takes a year or longer to go back up, cool, no problem, right? If you have that kind of time and patience. So, the long combo. Check it out. Decide if you like it for yourself. So, unlimited upside potential, but you're still getting a credit. Pretty cool. Hope this was helpful to you. If you like this, please give this YouTube video a thumbs up, give it a like, and please subscribe to my YouTube channel as well. Thank you for watching and listening. I will talk to you again soon.